Hey there, welcome back to the channel. Today, we're going to dive deep into the world of investing and talk specifically about bonds. Now, you might have heard the term bonds being thrown around when discussing investment options, but what exactly are bonds and why are they considered a safe investment? Well, buckle up, because we're about to break it all down for you. At its core, a bond is essentially a loan. When you invest in a bond, you're essentially lending money to a government entity or a corporation, and in return, you receive regular interest payments over a specified time period. At the end of the bond's term, you also get back the full amount you initially invested, known as the principal. One of the key factors that make bonds a safe investment option is their lower risk compared to other investment avenues. Unlike stocks, which can be quite volatile, bonds are considered more stable. This is because when you invest in a bond, you have a legally binding contract with the issuer, which ensures that they will repay the principal and interest according to the agreed terms. Another reason why bonds are considered safe is due to their fixed income nature. When you invest in a bond, you know exactly how much you will earn in interest payments, as they are predetermined at the time of purchase. This can provide a sense of security for investors, especially those who rely on a steady income stream. Now, let's take a look at the different types of bonds you can invest in. The most common types are government bonds, municipal bonds, and corporate bonds. Government bonds, as the name suggests, are issued by government entities such as the Treasury Department. They are considered the safest option, as the likelihood of a default by the government is extremely low. Municipal bonds, on the other hand, are issued by local government bodies and are typically used to fund infrastructure projects. Lastly, corporate bonds are issued by private corporations to raise capital for various purposes. Each type of bond carries its own set of risks and rewards. Government bonds, as mentioned before, are the safest, but they also tend to have lower interest rates compared to other types of bonds. Municipal bonds can offer tax advantages for local investors and are also relatively safe, depending on the financial health of the issuing municipality. Corporate bonds, on the other hand, may offer higher interest rates, but they also carry a higher risk of default, depending on the financial stability of the issuing company. One important factor to consider when investing in bonds is the duration or term of the bond. Bonds can have short-term, intermediate-term, or long-term durations. Short-term bonds can usually be anything from a few months to a couple of years, while long-term bonds can range from 10 to 30 years or even more. The duration plays a critical role in determining the interest rate offered. Generally, longer-term bonds offer higher interest rates, as they come with a higher level of risk and uncertainty. Now, let's discuss how to invest in bonds. There are several ways to go about it. One option is to buy individual bonds directly from a broker or financial institution. This gives you more control over the specific bonds you invest in, but it can require a significant amount of capital to build a diversified bond portfolio. Another option is to invest in bond mutual funds or exchange-traded funds, ETFs, that pool together bonds from various issuers. This can offer diversification and more accessibility, especially for retail investors with smaller amounts of money to invest. Finally, I want to briefly touch on some potential risks associated with investing in bonds. While bonds are generally considered safe, no investment is completely risk-free. One of the main risks is interest rate risk. When interest rates rise, the value of existing bonds decreases, which might affect the market price if you decide to sell before the bond's maturity. Additionally, the risk of default exists, especially for corporate bonds or bonds issued by financially unstable entities. It's crucial to do thorough research and consider the creditworthiness of the issuer before investing. In conclusion, bonds are a safe investment option due to their lower risk, steady income nature, and the legally binding nature of the issuer's obligation to repay the principal and interest. They offer investors a way to earn regular income and potentially preserve capital. However, as with any investment, it's essential to understand the different types of bonds, their associated risks and rewards, and the impact of interest rates. By doing your due diligence, you can make informed investment decisions and add bonds to your diversified portfolio. And remember, always consult with a financial advisor before making any investment decisions.